Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Well, hello, everybody. This is Ron LeGrand with another episode of the Mentor Podcast, designed to help you make more money, keep more of it, retire wealthy. And our guest today is Jim Maffuccio, who is a money guy with various subjects we can discuss today, but I don't know anybody that knows more about Jim than Jim, so I'm going to let him tell you who he is and what he does. Jim?
All right. Yeah. Well, Jim Maffuccio. Yeah. So I'm married. I have 5 grown kids. They're all launched, got grandkids, all of that good stuff. Live in Colorado at the base of the mountains here. And I actually run a co-founder of Aspen Funds, and we are a distressed debt player. We purchase non-performing second mortgages and work those out with the borrowers. We buy them at very low price points, so we have a lot of room to work with to help borrowers stay in their homes at an affordable payment structure and at the same time make really sweet returns for our investors in doing so. And then we also buy cash flows that are secured by residential real estate across the country, and we tend to lean towards the bread and butter, very non-exciting Midwest properties that don't tend to go up real high and don't tend to go down real fast. So again, we serve our investors by providing what we feel is a fairly safe passive investing model. And we've been doing this now since 2008 full time. We have a company. We're just hiring new people, and I think we'll have 20 employees by the time we come out of this current COVID crisis.
Okay, so what you're saying is you buy defaulted paper on seconds, and then you buy performing paper on first.
First and second on the performing, yep.
Okay, where on earth are you finding second mortgages nowadays on houses?
Yeah, that's a really good question, because there's not like a super established market for these. They're it's very much of a relationship-based industry. When you're talking first liens, you can find those. Those are out there, the bigger investment houses. The seconds, you really have to, it's really a network that you have to kind of get yourself embedded into, and a person can do that. But we've been doing it for 8 or 9 years, like I said. So we've established these relationships. The institutions, whenever these loans went into default, because they're second liens, they're treated a little differently than first, and so they charge those off. They get them off their books, and a lot of these defaulted seconds will probably never see the light of day, simply because they're of next to zero value to the institutions, and they probably don't even know they have them. But we're able to spring some of them loose, and it doesn't take a whole lot for we're a small company. It's not a multi-billion-dollar industry, but it's super sweet. I like to say it's not a real deep well, but the water's really sweet. So we've been able to build a nice business model around it.
Well, I can tell you, Jim, back in the day, which means the 80s and the 90s, that used to be the market. And, seconds were so common. And, I bought a lot of seconds myself. And you're correct. Once they go into default, very seldom is a second mortgage holder ever going to foreclose on the first. And they just write them off. So we used to be buying them for about 10 cents on the dollar.
Yeah.
What do you buy them at today?
Yeah, they range. Just a simple answer is our average is right in the high teens to 20%. If you'd asked me 3 years ago, it would have been the low teens. But we'll buy, if depending on the equity structure and the status of the senior in front of us, of course, we will buy. We've bought anywhere from 2 cents on the dollar, 2% of the unpaid principal balance, or UPB, all the way up to even 60% of UPB, and that would be a case where there's tons of equity covering even our position, and the borrower has good credit, and they're performing on their first. So we know we're going to get a full payoff eventually. We'll get that reperforming. So, but on average, the way it shakes out is it's typically in the high teens is what we pay. So yeah, you were buying them cheaper back then, Ron, for sure.
Well, everything was cheaper back then.
That's right.
except the interest rates. Okay.
Right.
So, look, you are talking to a lot of our listeners now that only understands about half of what you're saying. So let's keep this simple.
All right.
You buy a second mortgage for, say, 20 cents on the dollar, and you probably try to work it out with the borrower first before you foreclose. Is that correct?
Absolutely. Yeah. We only end up foreclosing less than 2% of the time. So our goal is to keep the borrower in the house. We're not out to take people's homes.
There you go. And you do that by simply adding their payments onto their note and restructuring it and let them start over. And what a service you provide for those folks.
Yes.
And then, of course, if you have to, you foreclose. Now, foreclosing in your case means you paid 20 cents for a dollar, because if somebody comes at a sale and buys it, they're going to have to pay the dollar that you paid 20 cents for. And if they don't buy it, you'll get the house at a low loan-to-value ratio, about the size of it.
Yeah, that's true. Unless we really don't want that particular property, if we can get a markup on what we paid for the loan. Again, if we just have to look at every deal, deal by deal, but if it looks like there's not enough equity in the property for us to go through the brain damage of taking the property, remotely rehabbing it and selling it, then, if we paid 20 cents and somebody comes at the auction and bids 35 cents and it's only, a year later, why not take the fast quarter,
Yeah, I used to tell my students at that time, if you don't want the property, don't buy the mortgage, because you'll get it for sure.
Yes.
Same with making private loans. So you're also in the pretty paper business, as I call it. That means people are actually making their payments on time. So you're actually buying them strictly for the yield, correct?
Yeah, that's right. And it's paper that larger institutions wouldn't touch. They would consider it at the very minimum scratch and dent. But it's usually they're reperforming loans that they've been through their trouble and now they're reperforming, and not always a perfect pay history. But since we have in-house the core competency of doing workouts and doing, what you might call loss mitigation, we don't have any problem buying these. And so we buy them at a pretty high yield because we're buying them at a discount off of the principal. And so it might be let's just say simple numbers. If it's a 8% loan on its face value, that's what the borrower's paying, but we're only paying, 75% of the balance of the loan to buy that. Then in essence, we've got a loan that's yielding in the low teens. And so we make the low to mid teens on our paper based on our investment until the loan pays off, which happens a lot these days. And when it pays off, of course, we don't get just our 75 cents on the dollar back. We get the whole dollar back. So it's a really nice model. In today's refinance climate, we're seeing a lot of these loans that, we paid 60 cents on the dollar for, and we get paid dollar on the dollar when they pay off. So it's a pretty sweet thing.
If I was buying it right now, I'd buy the note and then go do what I could to get the borrower in there and get them refinanced at these low rates and get cashed out.
Yeah, that's exactly right. Yeah.
So really what you're discussing is a whole business within the business that is not very many people actually teaching that today. I used to teach it myself. It's called the paper business, and most people coming up today have no idea how many billions of dollars there are behind the buying and selling houses business, just dealing with the paper that's attached to the houses. And I like you, I love defaulted paper.
Yes.
Because I can buy it a whole lot cheaper and I can make a lot larger yield on it.
Yeah. And with seconds, Ron, you ultimately control a lot more real estate value for less dollars, because you really have the leverage. If you think of it this way, it's kind of like we have a built-in financing, and that would be the senior lien, which again, the borrower is typically paying on. But even if they stop, we have the right to step in and in most states and to reinstate the first or to make the payments on the first. And so in essence, we've just picked up a position with financing included. So, I always like to say, we say in our industry, when you drive through any metropolitan area, the buildings that stand out the tallest, you don't see the names of rehabbers and flippers up at the top. They're usually banks, right? And so there's a little bit of a hint there.
Yeah. Okay, I got it. We probably need to point out here that when you're buying a second and you have to foreclose and take the property back, the first cannot call the loan due, as long as they're getting paid, of course.
Yeah,
because
that
of
is
the Garn St. Germain.
yeah, that is more or less true. There are some states that actually we do not have where the first is not required to allow us to reinstate. And
Yeah, well, they're not required in any state. It's just they can't call it due because title changed hands. But not too many firsts won't let you make payments if you want to.
Yeah, that's very true. Yeah, so that's in general, that's the model. And that's honestly, that's what creates part of the opportunity, is because a lot of folks out there, you know, firmly believe that you cannot foreclose from second position simply because the big institutions never do. Well, you absolutely can. And we do it all the time. We start foreclosure on probably 60 to 70% of our files. And that could just be as simple as an attorney, default letter. And, by the time we get to the end of the process, as I said before, less than 2% of the time do we actually have to go through with it. It just there's a waking up process with these borrowers, because in some cases they haven't heard from a lender in 5 years, so they just figure, hey, this is water under the bridge. We don't owe this money anymore. And so it takes a little bit of convincing that, you actually really do. You signed a promissory note, and, we're not after blood here, but the sooner you work with us, we're really nice guys, and we underwrite you, and we don't want to put people back into an unaffordable situation. And
5 years of free payments is enough.
Yeah, I mean, hopefully you save that money or you invested it wisely.
Yeah, didn't buy too many drugs with it.
Yeah, no kidding.
Okay. Hey, look, you, I understand, are a real estate developer. Is that true?
Well, that's what I'll say. That's what I was, and that's not to say I'll never develop again. But I was I was a developer in Southern California, and that's not a large pond to be a small fish in, because I got pretty much got washed out twice. I didn't learn the first time in the early 90s, so I decided I'd go at it again, and but I lost everything again in the mortgage crisis. And I thought I was pretty well positioned because I was focused on affordable housing, but affordable is a very relative word in Southern California, in any of the coastal markets. And so that was such a big dip that most of us went underwater so deep we couldn't hold our breath long enough to survive. So,
problem was, because I was there with you, any of our listeners knows me know that I was the same situation with 32 developments going on simultaneously in 9 states, all with students. I had 5 of the most beautiful housing developments ready to build houses on you ever seen. Wow. They had the roads in, water, electric, sewer, and everything ready to go vertical. And then I had commercial developments of all types, including fractionals and not timeshares, but fractionals and retail and so forth. Problem really wasn't that capital dried up. The problem was the whole market dried up. There's no more buyers. You build a dumb thing and there's nobody going to buy it anyway. So, I went through my 2 or 3 years trying to deal with the banks. Isn't it amazing how negotiable they get when they figure out that their problem's bigger than yours?
Yeah, exactly. They absolutely have to get, and that's again back to the paper game, and whether it's opportunity created through something like the mortgage crisis that we went through. Of course, that created a tsunami of this, toxic assets, they called them, where they absolutely had to get rid of them. But even in good markets, banks cannot keep defaulted or even troubled paper on their books. They have requirements, and they have reserve requirements and debt assets. Even a loan that we would think is perfectly good, that we would buy in our fund all day long, might be a rolling 60-day late loan. Well, they've made their payments for 12 straight months, but they never cured their 60-day delinquency. Well, the bank needs that off their books. And we're saying, hey, well, where do we back up the truck? Because we'll take those. So we buy them at a discount. So, it helps them, helps us.
What your amounts to is you're looking for problems.
Exactly.
Because you fix problems. That's how you make money.
That's
how you make
correct.
Money in real estate, too.
Yeah.
In case of houses, it's either a house problem or a seller problem, but we are always fixing problems. There's no different in paper.
That's correct.
So you had these developments going on, and did you have the same problem I had? There just was no exit strategy?
Yeah, well, there was an exit strategy, but it wasn't a profitable one. So,
I mean, there's no way to sell them.
No, that's right. Yeah, that they got upside down so fast when things turned. I mean, we were doing some, manufactured homes on permanent foundations in an outlying area of Los Angeles where our total costs in was about, in the low 200s, and we were going to sell these in the mid to high 200s, and we were 100 grand less than the stick built, site built housing in the surrounding area. So we thought, man, we're gonna kill this market because nobody can compete with us. By the time we were done, and it was a very short amount of time to fall off a cliff. It doesn't take long to fall. By the time we were done, there was our houses, we had lost them to the lender, and they were selling as REO in the low 100s, well below replacement costs. And mind you, these were brand new structures, well below replacement costs. You can't.
That was normal.
Survive that. Yeah, exactly.
Absolutely normal. Yeah. I had a project I was about ready to build on in North Carolina, and those things were going for $250 to $300 a foot, and we could build them for $125. Wow. Of course, an idiot can make money in that market until the $300 a foot turned into $150 a foot. And I mean, like overnight, man.
Crazy.
And that's assuming you could even sell anything. So I feel your pain. Man plans, God laughs, huh?
That's right.
But
yeah, that's right.
Man, those spreadsheets, they look so nice.
Yeah. We actually won a Gold Nugget Award. We had this little project we did in Ventura County, and we actually came up out of the ground and got all but the last 4 or 5 houses sold before we finally had to close up shop, and that was in '97. And I mean, I like to call it my most successful failure ever, because we did win a Gold Nugget Award, and we had all kinds of people come look at it because it was a very unique designed project. But there's making money and there's building nice stuff, and hopefully you can get both of those lined up in the same timeline, and actually make a profit. So
you decided not to be a developer anymore.
For the time being, that's right.
Amen, brother. I made the same decision. But I am doing a lot of land projects right now with students. We just take underdeveloped land and get it ready to sell it to developers. And,
that's where it's at right there. That's where the least amount of brain damage and most amount of markup is creating those entitlements.
Correct, and least amount of risk.
Right.
In fact, some of them buy with owner financing, some of them we got to pay all cash, but I'm not paying all cash for most of them until we get them entitled for something. But I'm enjoying it because I don't even have to leave my desk. I sit at home and do all this, and the students send me the stuff, and it's pretty easy. So learned the same lesson that developing is very risky.
Yeah. You don't know, you don't know what things are going to, there's a long time, especially in the coastal areas where the regulations, it might take 3 or 4 years to get a project approved. You have no idea what the market's going to look like in 3 or 4 years. So you're speculating, whether you're a speculator or not, you're speculating.
Well, I wouldn't develop in that kind of a market anyway if it takes that long.
Yeah.
All right. So you have a fund, which is nothing more than a collection of people investing in a private placement, and they're part of the operating agreement. I have one of those about to launch as well, actually for these land projects. So tell me about your fund and what does it do?
Okay, well, we have 2 different types. First of all of these are for accredited investors. So